What's up, military millionaires? I got an exciting email yesterday and I wanted to share it with you about how the Thrift Savings Plan has added new lifecycle funds and what this means to you. Intro. Look, I don't know if you're on the Thrift Savings Plan mail out list or email list, but I got this email just yesterday. As of July 1st, 2020, there are 10 lifecycle funds instead of the 5 there used to be. Now, for those of you who don't know, and there's other videos that you should check out, I have videos on TSP strategies and some articles. Lifecycle funds, essentially, they change your allocation of funds as you age towards that target date. And so what you do is you pick the date that you plan on retiring, and then you choose that lifecycle fund based on when you're going to turn 60 or 70, whenever you want to withdraw your money. And when you're young, it's more aggressive. So it's much more like my current strategy, which is like C fund, S fund, I fund. And as you get older, it gradually becomes more into like the G funds and other bond related funds, so that if the market crushes, you're not going to lose as much of your portfolio. So it won't gain as much value, but it's not as risky. And so as you get older, that's what you want. You don't want quite as much risk. So I always recommend to people, if you don't really want to know a ton about funds, like if you don't want to spend all the time worrying about it or researching it, or you just can't comprehend it, or you just want something that's completely passive, you never touch, you never change, whatever, the life cycle funds are great. But there's been one fundamental issue for me for a long time with them. And that is that they only had Lifecycle Fund 2040, 30, 50, 60, whatever. So in essence, like for me, it wasn't a big deal because I'm going to turn 60 in 2050. So I could just choose the Lifecycle Fund 2050. But say you were born 5 years later, you would be torn between, should I invest in the Lifecycle Fund 2055 or 2050 or the Lifecycle Fund 2060? And so one of those would put you riskier for a longer period of time and could pose a risk, and the other would put you more conservative, closer to or earlier, which means you might not have as much money in the fund as you get closer to retirement. So kind of a downside, not a huge deal, but the Thrift Savings Plan now has every 5-year increment. So there is a 2025, I think it's actually from 2020. So like a Lifecycle Fund 2020, 25, 30, 35, 40, 45, 50, 55, 60, so on and so forth, which means that it's going to be much more accurate. So now you're only going to have to worry about like deciding, 2 or 3 years off one way or the other, instead of potentially a whole decade or a half a decade off, which just means that you're getting a better allocated fund for you. So it goes through here and it's got all right, so from 2025, Lifecycle Fund 2025 all the way through 2065 is the new lineup every 5 years. And that's what this email shows right here. Now, I want to just show you something real briefly in the Thrift Savings Plan. And I know I could show you my personal account, but you'd be underimpressed or underwhelmed, since I did not know any of this stuff when I was first starting with the Lifecycle Funds or with any of the funds. So my account would have 2 or 3 times as much money in it if I'd just known what I was doing at a younger age. But so what I want to do real quick is I just want to show you this. So we're going to use Lifecycle 2060, right? So that's for participants who will withdraw their money, in between 2058 and 2062. So the objective, high level of growth with a very low emphasis on preserving assets. And then as you shift, so let's do like 2025, to achieve a low level of growth with a high emphasis on preservation of assets. So it shifts over time, right? And you can see the fund allocation over here. And so it's got G, F, C, S, and I funds adjusted quarterly to see how this works. So check this out. This is what I think is cool. Now, this one just launched. This one started in 2020. So, there's no like chart right now as of like monthly returns. Whereas if we look at the 2050, they've got a chart over the last 12 months, what they did. You can see kind of lifetime, like the growth of $100 since inception. So this started in 2011. It would be worth $225 right now, whereas the 2030, which should be more risky, $100 would be worth $256. So a little bit riskier. Anyway, I don't need to get too into the weeds on that. But check this out. Look, this is on the website itself. So you can see right now, 0.43% G fund, 0.57% F fund, 48.5% C fund, 15.5%, almost 16% S fund, and almost 35% I fund. So personally, currently I'm at like 75% C fund, 25% S fund. Now, at one point I was C, S, and I. And so either of those allocations is good. when you're trying to be more aggressive and grow. But look at this. Watch how it shifts. So you hit this button, and you can just see how as it grows closer to retirement date, you'll see the G fund, the orange there, is really growing and becoming a much larger portion of the portfolio, whereas the other funds are slowly dropping. And what that does is when right now, say we're there, 65% of your G fund, that means that if the stock market took a 50% hit, right, just got obliterated, 65% of your money wouldn't have lost $1. So you would have only taken a 50% hit on the other 35% that's in those more aggressive funds. So your hit would be much smaller. So, I mean, that's like what, a 15% loss over your portfolio, which, you know, if you have $1 million in there, which is very possible, that's still $150K down, but that money will come back, but you didn't lose, you know, $500,000. So it becomes much, much more secure, much less risk. So if you are somebody who doesn't want to deal with their funds or wants it on true autopilot, I suggest you just pick whichever Lifecycle fund is closest to your target retirement date, put the money in there, and just set it, forget it. Like, you never touch it again. Just continue to contribute into that account, and it'll do the best match of like mixing and matching, like high risk, high reward to low risk, lower reward as you age, so that when you can afford those risks, it takes it. When you can't afford those risks, it doesn't. And this works out in your favor no matter what your personality is. So if you are a like high risk or a low risk person who's like super risk averse and can never take risk, if you put it in here, it's going to put you in a more risky fund than you would choose. So you'll get a better return. But then by the time you're older, it's still going to manage or mitigate your risk, right? Whereas if you are a super high risk person like me, who is not risk averse and jumps into things, that's great for me at a young age, probably about what I would be doing. In fact, it's fairly close to my allocation. But as I get older, it'll automatically move money into the G fund. So realistically, I will eventually move all my funds into an L fund once I either no longer want to mess with it or just want to put it on autopilot, or when I realize that I'm still taking risks I don't need to, and I want to get into like wealth preservation. And I've got a video on advanced TSP strategies you should check out. But this is not to say that you can't go and roll your money into a self-directed IRA later and invest in real estate or do some private lending. There are a lot of options that you can take with your thrift savings plan down the road, right? So there's nothing to say that you can't do other stuff with this money. It's just, I like leaving the thrift savings plan alone as my like super duper emergency fund, because no matter what, this will still be here if everything else fails, so that, you know, even if I only have $500,000 in this, by the time I'm able to retire at a 4% safe withdrawal rate, that's an extra $20,000 a year that I can pull out of it every year for my survival. So an extra like $1,500, $2,000 a month that I can pull out and utilize towards my retirement. So it's a good safety net, which allows you to take a little bit more risk. And if you're smart with this as a young service member, and you have listened to some of my other videos, which if you haven't, go do it, you can actually have way more than $500,000 in that account by the time you get towards retirement. Like I said, I would have double or triple in it right now. Hell, I'd be like halfway to half. I mean, anyway, it's sickening to think of what I would have done if I'd known how to use this thing earlier on. But yeah, so that's a brief overview of the new thrift savings plan, Lifecycle funds, what they are, why they're important. If you have other questions about the thrift savings plan, please don't hesitate to let me know and ask them, or put them in the comments. Like if there's other thrift savings plan related type stuff that you would like me to do, I would love to talk about it. I think there's an immense amount of value in understanding this 401k, IRA, whatever, the thrift savings plan retirement system. It's just incredible, and unfortunately it's overlooked by a lot of investors. So I definitely recommend that you check it out, and I definitely recommend that you make sure you know what you're doing, because if I could change anything, like the one thing I would tell anybody who joins the military about their finances is set your TSP up immediately, so that if you put 20% in it right off the bat, it doesn't feel like you're losing money every paycheck because you never saw that 20%. But if you start at 0 and then you increase it to 20%, well, now it feels like you're getting a smaller paycheck. So I would say put at least 20%, if not more, into your thrift savings plan immediately when you start getting your paycheck. And the more, the better at an early age. The more you can put in at an early age, the more money you'll have, because the longer that money will compound. So putting in 20% when you're 18 is better than putting in 30% when you're 30, right? Like, if that makes sense. And so the more money you can put away at the beginning, the better, because of compound interest and how all of that stuff works. So the one thing I would tell anybody joining the military is the first thing you need to do with finances is put at least 20 or 30%, the more the better, into your thrift savings plan. Set it up correctly so that the money is going into a decent fund, which luckily they're not just putting money in the G fund now. It starts into your Lifecycle fund. But make sure you know where that money's going. Make sure you understand just briefly funds, allocations, contributions, and how to change it. And, I try to work with the Marines that I work with and get their password, or work with them on their computer and walk them through this. Not everyone's going to do that. That's fine. But just watch my videos, and I will help you with this. If you have questions, hit me up. Like, this is the most important thing you can do for your financial security at an early age in the military. And also, if somebody tries to tell you to liquidate your TSP for an investment, almost guarantee, no matter what that investment is, it's a bad idea. Now, there are times where it will work, where you can take a loan out to buy properties and stuff like that. But I'm not a huge fan of anything like liquidate your TSP for whole life insurance. Terrible. Liquidate your TSP for self-directed IRA. You can roll it into a self-directed IRA later, but don't do it now. The TSP contributing to it, especially now with the new blended retirement system with the government matching, you can't beat that. I mean, a 5% match is an extra 5%, like a 5% bonus on your paycheck. So that's awesome. Anyway, all that to say, before I start rambling, thrift savings plan is super important. Make sure you understand how to use it. Let me know if you got any questions. You guys have a great day.